All right, we are looking at no change, as has become the norm lately at the beginning. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment, and Bloomberg Open Interest starts right now.
Coming up, a new street high. Oppenheimer's John Stoltzfus sees the S&P 500 hitting 7,100 by the end of next year, thanks to a stronger economy. And Nvidia draws scrutiny out of China. They're opening an investigation into the U.S. chip maker over potential anti-monopoly law violations. Plus, we've got M&A news on this Monday morning. Omnicom is buying Interpublic in a deal that will create the world's largest advertising company. Let's take a look, though, right now where markets are trading. As I said, not a lot of change in terms of futures. S&P futures are down 0.05%. Nasdaq futures off a little bit more, but not a lot of movement there, as has become the norm lately. We start out with nothing doing, and then we typically, over the last few sessions, rise to an all-time record. The U.S. 10-year yield right now up about 2 basis points. Just still under 420 at 417, 418 right now, so not a lot of change there either. Do we see some individual movement today?
We do, and it's a good thing that we're so exciting and interesting. That little change on the S&P 500, we can still make it worth watching. But let's look at the micro here, because you have Nvidia falling after trying to open an investigation into the chip maker over potential anti-monopoly law violations. Stock is down about 2% pre-market. Then you take a look at Super Micro, jumping over 8% right now. That's after Nasdaq granted the firm more time to become compliant with listing rules. Clearly that time is needed here, because shareholders rejoicing right now. And then I wanted to highlight Workday and Apollo. They're both rallying. That's after an announcement that they're set to be included in the S&P 500. Interesting, especially for Apollo, the private markets becoming public. So that's the micro, Matt Miller. But of course, it's a really interesting week when it comes to the macro as well. We had that jobs report on Friday. And if I skip ahead to Wednesday, we have a pretty important inflation print as well. Yeah,
inflation will be fascinating to watch, especially since the Fed meeting is coming up. December 18th is when we get that decision. I saw with the University of Michigan survey some pretty amazing detail in the charts. And anyone can type, anyone with a Bloomberg can type WSL election and find some really interesting tidbits. For inflation expectations going forward 1 year, Republicans, after Donald Trump was elected, dropped their inflation expectations. Now they only expect 1.3%. Democrats surveyed expect 3.2% inflation. Yeah. So this polarization, which I believe is a special word this year, is really evident in the University of Michigan survey.
It's fascinating. Of course, we broke those numbers, and overall, the 1 year inflation expectations rose. But to see it boiled down that way by, of course, political party really tells you quite an interesting story. But what it means for markets, we'll see there. Of course, you have these expectations, inflation worries coming through, but we have a new biggest bull on Wall Street.
That's what I was going to say. Like, it's okay, I guess, if prices rise, as long as assets rise as well, because then you can afford.
The price of the S&P 500 inflates as well. But we're talking about John Stoltzfus, of course, 7,100. That's a gain of about 17% from here, which would be pretty remarkable given that we're up 28% in 2024.
Yeah, it's been absolutely massive. Let's talk to Cole Smead about this. He is the CEO of Smead Capital Management, normally in Arizona, joins us here on set. We're thrilled to have you here again.
Good to be here.
Cole, thanks for joining us. What do you think about another new bull? It's actually not surprising. I come in every morning expecting someone to have raised his or her target.
Yeah.
And we're up almost 30% now, year to date, after like a 25% gain last year. So can this continue?
Well, so you mentioned the Michigan surveys. Go look at the Consumer Confidence Board. They're out, polling on, how enthusiastic are about the stock market. And we're at all-time highs on that, too. So, the question is this the real world? Okay? The real world, supposedly, is where everyone puts money into the stock market, and they all get rich no matter what. Okay? It doesn't matter what government funding problems we have, which we do. I think Bessent's talking about getting to 3%, deficit in 4 years. Okay? And so what I find really interesting right now is, why is Yellen going shorter on the curve when she goes out to fund? Why are we still spending money like drunken sailors on leave? And effectively, the stock market's saying, who cares? It's a positive feedback loop. That's any news. Hey, inflation's weak. Great, we can lower rates. That's good for stocks. Hey, inflation's stronger. Okay, great. Stocks will pass that on. Everything's positive feedback loop. The only issue is, if you go look at foreign owners or U.S. households, they've never owned so much U.S. stock in their lives.
Right.
And the problem is that bodes terribly for 10-year forward returns. We think the S&P is going to lose money, and yet everyone's running around thinking about how rich they can get right now. The problem is that's not how the game's made.
Well, let's talk about positioning a little bit more, because you always leave us with really interesting thoughts there that we then talk about for weeks on end. But is the fear around positioning that everyone is all in, basically that there's no incremental buyer left? Why should that stat concern me? That's
a great point. To your point, at tops, you run out of buyers. At bottoms, you run out of sellers. And that's the inherent issue with tops and bottoms of the market. So again, using those ownership data, right? Who else can come in now that hasn't already begun participating? My dad was just in Zurich last week. It's kind of a funny thing to think about. 12 years ago, I was there with him, and the Swiss would look back at us like, oh, you silly Americans. Oh, you're such idiots. And the reality is we had a lot of problems that were known. And yet at the same time, the stock market was cheap because of the fact that those were known problems. The difference is now we have problems, but no one chooses to look at those. You go there now, and they'll talk about American exceptionalism as though it's some brand new story there. And the reality is, no, they're just very comfortable with it now, which is why their ownership, like the U.S. households, is where it is. So it shows brimming confidence. The problem is when the public of investors, and those type of investors are brimming with confidence, you want to be doing something else. Okay, now, the S&P doesn't look good. That doesn't mean you can't own stocks. But, you know, again, 10-year Treasury to S&P, I mean, I think that risk-free rate is going to haunt people. And if the government has trouble funding, it's the crowd-out effect, like we learned in our classical economic theory classes, which is that the government's ability to fund in the capital markets could crowd out private demand. And again, these are things that are classical, but I'm 40 years old. I mean, no one's talked about these since I was 21 or 22 in a class.
So what do you do then as someone who invests mainly in stocks, right? You're not hedging with bonds. You're not buying gold and Bitcoin.
Yeah.
So what do? Do you have to just do bottoms-up research? Do you look at, maybe different countries that haven't done as well, different regions?
Yeah. You got to care about what you own versus just trying to be broadly invested and trying to get rich in stocks. Okay, and again, that's just a different game. So to your point, Matt, it's like Wee Willie Keeler. Hit it where they aim. So where is the index not today? Whether we're talking, MSCI World or, S&P 500, it's not in energy. I mean, here we sit. Everyone's really worried about supply and demand dynamics and whatnot. What is Chevron saying last week? Hey, we're cutting CapEx, a.k.a. we're being very stringent on the capital we use. What does that argue? We're probably not going to grow production in America. We've been the largest non-OPEC plus grower from a 20-year perspective, full stop.
Yeah.
The difference is, as you look at CapEx in the space, it's dwindling. And the question is, who's going to be the marginal supplier? The economy continues to grow globally, despite all these problems we do have that are real. At the same time, where's the marginal barrel going to come from? We were that marginal barrel. And look at the allocation of capital to the space the last 3-4 years. It's so starved that we can't produce the barrels because there's no money there. Wall Street's not raising money there. Look where they are. It's a completely different framework. So a strong economy is what we do have based on what's going on with the federal government, though. Okay? That we inherently have a strong economy because we're spending a lot of money. That's going on a lot of places. So we look at the bet as from a bigger picture perspective. What's economically sensitive that people begin to fear for some reason or other? Think of banks a little over a year ago. Oh, economic sensitivity, we got problems. What happened? Great place to go hunting and fishing. You made really good money as you played that coming back.
Let's talk about the energy names a little bit more, because when you think about the broader oil market, obviously it just feels like it's been so supply driven. And I hear what you're saying that, the Chevrons of the world, the U.S. isn't producing to capacity here, but you haven't seen that filter in through to, the price of
prices,
crude.
Yeah, no
we're
question.
below $70 a barrel. We're at $68 a barrel right now. How long does it take for what you're talking about to manifest itself in the actual prices here?
It's a great question, and I'll give you a quick cheat, and then I'll explain it. You got to read Doug Terreson's new book, Can't Deny It. The former Morgan Stanley oil analyst, then was at Evercore. He's got a great book out there. He's now retired, and I think he's on the board of Phillips 66. I say that because he gives a great story of the history of the super majors combining in the late 1990s, and then this idea of what he called pledgers, people that were going to be disciplined in their capital. That's what we didn't have during the 2010s. So what happened during the 2010s, we grew supply. Did anyone make any money from that? No. They lost billions and billions and billions. Now they're being disciplined, and isn't it funny? Mr. Market is saying, we know you're disciplined, but you're screwed. Okay? Mr. Market was wrong before. he's going to be wrong on this again, because that discipline that Chevron's showing, we don't own them, but in this space we own Occidental Petroleum, we own ConocoPhillips. You can go north of the border and find companies like Cenovus, long life assets. Shale have quick declines. If you go out and buy tar sands, you can do 20 or 30 years in asset. So again, minimal capex that you have to maintain for a long time, but it's not a big 3 to 7 year swing in the asset like you see here.
Cole, I'm just wondering, making no comment on your political persuasion, right?
We can if we want.
You're in Arizona, you're in finance.
I agree.
I'm guessing you're surrounded by Republicans,
Yeah.
but you're saying you don't think we're going to grow oil production. That's something that Trump has been promising.
Correct.
You don't think Bessent's going to be able to bring deficits down to 3%? Because let's be honest, come on.
Yeah.
And I wonder what your take is also on, mass deportation. That's a problem for the labor force, right? Tariffs, that's a problem for inflation. How do you square these circles?
To show my hand, I'm a card-carrying Republican, but I'm also a card-carrying capitalist, as Buffett would say. So we think we're at peak Trump. The idea of what Trump is going to do is at a peak point where, again, the positive feedback loop. Oh, it's already done. It's going to work out great, and it's all going to be fantastic. And I'm not saying he's not going to help things, but we have real problems to deal with, like in our deficit, geopolitically, et cetera, and those have got to be addressed, and no one seems to think there's anything short of ideal, okay? And I say that because, do I think government spending should be cut? Yes. I live in Arizona. Do I think our border should be secured? It's a massive problem in our state. That being said, that, one question we have, it's, again, theory question. Will the low-end wage data show, when we shut the border off, what's actually going to show up in the labor market? I think that could cause near-term pressure in wages, and I think will show up in the Fed data if that theory is correct. But again, that's a theory. We will see. But I point it all out because, again, from our chair, it's like, great, tax rates are going down on corporates. That's kind of baked in. People are beginning to think that we're going to go from 21% somewhere closer to 16. And the only issue is, again, at 22 times on the S&P, or if you're going to go to the bluest of blue chips and say use like a company like Amazon, if you back out their you back out their stock-based comp from their free cash flow, they're doing about $20 to $25 billion in free cash flow. We're talking about a $2.3 trillion company. So a blue chip is trading at 100 times free cash flow. And that sounds great. It just never works out like that. It's fantastical. It's idealistic. And the problem is we like casino games in this country. It's why sports betting is doing so well. And we love that casino. We're a deep, big casino, a.k.a. the stock market. Right. The danger is we're treating it like a risk-taking venture, when the reality is you make money slowly, not overnight. There's a big chasm in that idea.
All right, Cole, we got to leave it there. Great to see you, as always. Really interesting perspective on peak Trump and how it relates to these equity markets. That is Cole Smead of Smead Capital Management. Meanwhile, a quick check on futures here. Less than 20 minutes until the bell. You can see pretty much unchanged, maybe a little bit lower when it comes to the S&P.
We can just do away with the futures checks at this point,
we can just say futures are unchanged, but we do have some movement under the hood, thank goodness. Let's get to Bloomberg's Isabel Lee here with some news.
I'm looking at Intercom. We have Omnicom agreeing to buy Intercom in a deal that would put the two combined to become the biggest, largest ad agency in the world. And some calculations put this at $13 billion. And if you want movement, we are seeing movement. We have Interpublic shares jumping as much as 14% in pre-market. It's down around 12%, but still really high up compared to the indexes we were looking at earlier. We have Interpublic shares year-to-date falling around 10%. Its market cap is $10 billion. And the bigger one here is Omnicom. Its market cap is $20 billion. It rose around 20% so far this year. So as we know, ad agencies have really been facing a lot of pressures from Google, Meta, and just AI in general. And many experts believe that those could all take the job of the creative work that agencies provide. So this is why a deal like this isn't unsurprising, according to Bloomberg Intelligence. And we have another analyst saying that the fact that these two fierce competitors are combining is an indication of the headwinds ahead.
All right, really interesting deal news there. We're also keeping an eye on Macy's, of course. A lot of drama underway at that company, but we're looking ahead to earnings.
Definitely. So we have Wall Street Journal reporting that we have activist investor Barrington Capital building a position in Macy's and also pushing for change. So the size of the stake still couldn't be learned, but Barrington has teamed up with a property owner called Thor Equity. So both of them want the representatives in Macy's, and they both believe that a real estate subsidiary will be able to push Macy's to the next level because they believe that Macy's stock now is undervalued. In 2015, Macy's stock was trading as high as $70, and now it's just around $16. They believe Macy's real estate business alone could be around $5 to $9 billion, and the market cap of Macy's right now, just $4.5 billion.
We're also seeing some of the ROI story come through from AI, right? In terms of Oracle, they're just killing it on the cloud.
Killing it, and today they report earnings, and you have a lot of investor enthusiasm right there because shares are up at around 82%. So Oracle is on track for its best year in over 2 decades. So its one struggling business is finally being taken seriously by investors. For a long time, it has really struggled to find its place in the lucrative cloud storage and renting business that has been dominated by AWS and Microsoft. But now it's gaining some traction thanks to Uber and TikTok. Those are both its clients, and we'll see right after the bell today when its earnings report. But so far, it's looking like a good year for Oracle, Matt.
Cool. Isabel, thank you very much. Isabel Lee there talking us through some of the stock movers that we're watching this morning. Coming up, we're going to take a look at a big one. China takes aim at NVIDIA over potential anti-monopoly violations. We'll take a look at the accusations and the stock movement next. This is Bloomberg. Let's get out of high interest. Look at what's making headlines around the world. First off, the amazing story in Syria. The president, Bashar al-Assad, his government fell with astounding speed over the weekend. Assad fled to Russia after Islamist rebels rolled into Damascus and ended his despotic family's 50-year reign of terror. The toppling of the longtime ruler is sending shockwaves through the Middle East and will be a major blow to Russia and Iran, his main foreign backers. President Biden addressed the turmoil in a press conference earlier.
The fall of the regime is a fundamental act of justice. It's a moment of historic opportunity for the long-suffering people of Syria to build a better future for their proud country. It's also a moment of risk and uncertainty.
We should note that the U.S. and Israel have been bombing targets in Syria. The New York Police Department is releasing new images of the suspected gunman in the killing of health insurance executive Brian Thompson, including one of him in a taxi that he used after the shooting. A gray backpack believed to be worn by the gunman was also retrieved in Central Park and reportedly contained a jacket and Monopoly money. Finally, in a move reverberating throughout the entire worldwide sports landscape, Juan Soto has decided to sign with the New York Mets, leaving the Yankees, for a record 15-year contract worth $765 million. That surpasses the total valuation of Shohei Ohtani's $700 million 10-year contract with the LA Dodgers last December. And Katie, one key to this is that Soto gets $75 million as a signing bonus, and then he gets all the money each year. So like $46 million a year for the next 15 years if he stays that long, whereas Ohtani deferred almost all of his $700 million and only gets $2 million a year. So it is a massive pay package.
Yeah, it is just staggering in terms of some of the numbers that we're talking about. Almost makes me want to watch baseball. But let's talk about NVIDIA here because we're keeping an eye on shares. The stock falling after China announced a probe into the chip maker on suspicion that it broke anti-monopoly laws. Joining us now with more on the allegations, I'm pleased to say we have Mandeep Singh of Bloomberg Intelligence. So this is related to the 2020 acquisition it made of Mellanox Technologies. Shares are down over 2% right now. But give us some context. What could this potentially mean for NVIDIA?
I mean, when I look at NVIDIA, they've already gotten a subpoena from the DOJ about, a potential monopoly with the chips, and they do have a 90% plus share when it comes to the accelerator market. And given, what's going on with Google here in the U.S., I'm not surprised the Chinese antitrust authorities feel they have to do something about businesses that operate here. And one of the biggest businesses that operates there among the U.S. companies is, NVIDIA with their chips. And look, when it comes to chip making, NVIDIA clearly has an ecosystem effect that, once you start using their chips, it's hard to mix and match. You can't really use an AMD or, an Intel to train your AI. If you are an NVIDIA shop, and, right now we are in a supply-constrained environment, so NVIDIA can say this company will get the chips, some other companies may not get the chips. And I think there are grounds for any antitrust authority to say we want to look into their practices.
Grounds, but isn't it stupid? I mean, there was a great New York Times expose about how NVIDIA basically sells so many products to China, even when it's not allowed to. What if NVIDIA just said, okay, we won't sell any more stuff to China?
Well, so again, I don't think the Chinese authorities want their companies to be deprived of, the chips that NVIDIA is selling. It's more about the practices. And they did the same with their home companies. Alibaba and Tencent had a similar investigation where they had to make changes to their practices in terms of how they operate. So, look, when it comes to antitrust, there are two big authorities in the U.S. and in the EU. And the Chinese authority wants to send a message that they are as powerful, when it comes to these things as the other two.
So NVIDIA really at the intersection of a lot of these policy and geopolitical tensions between the U.S. and China. Sadly, we have to leave it there. Mandeep Singh of Bloomberg Intelligence joining us there. And still ahead on open interest, Omnicom agrees to buy Interpublic, creating the world's largest ad company. More details on the deal later this hour. This is Bloomberg. All right, welcome back to Open Interest. A check on futures. We're still going to do it, even though futures pretty much unchanged at the moment on the S&P 500. A little bit more direction when it comes to big tech, down about 0.2%. And I know I can always rely on the small caps to do something interesting, and that's what's happening right now. The Russell 2000 up by about 0.6%. Of course, this is just a snapshot with 4 minutes to go until the opening bell. We'll see what happens when the cash session finally starts, and we'll discuss it all with Nimrit Kang. She is Northstar Asset Management Chief Investment Officer. That conversation coming up next. This is Bloomberg.
We are moments away from the start of trading on this M&A Monday. This is Bloomberg Open Interest. I'm Matt Miller. In terms of futures, not a heck of a lot going on, but we've seen over the past few sessions that we start out like this and then make big moves in the afternoon. The Nasdaq futures also down 0.2%. Russell futures up 0.6%. A little bit of that momentum, a little bit of that shift happening. You hear the bell and see it on the New York Stock Exchange. They have Ashland ringing it there. I think this is fascinating. PTC down at the Nasdaq market site. They do CAD software. Would seem uninteresting, right? They're celebrating their 35th anniversary of listing. They have outperformed massively the S&P 500 and the S&P 500 infotainment index, or whatever we call it, the technology index. They're up like 11,000%. So they've done very, very well, and that celebration is deserved.
We should have them on the show on Open Interest.
Yes.
Because that is very hard to do, to outperform the S&P 500, at least over time. Because today, not much going on, as Matt said. We do have more direction right at the open here. You can see the S&P 500 down 0.2%. The Nasdaq 100 down 0.4%. For the S&P 500, we're coming off of 3 straight weeks of gains. We know that we're close to all-time highs. This is the best year in 6 years, so maybe a little bit of a breather right now. The Russell 2000, though, as Matt highlighted, more movement in the small caps to the upside. The Russell 2000 up about 0.6%. That rotation trade still underway, at least at this moment. But let's look under the hood here, because some stocks to keep an eye on. We have NVIDIA lower. That's after China opened a probe into the U.S. chip maker, investigating potential anti-monopoly law violations. This is related to its 2020 acquisition of Mellanox Technology. Shares down about 3%. We'll continue to follow this story, but we want to also keep an eye on shares of U.S.-listed Chinese stocks. They're rallying after the country vowed to be moderately loose on monetary policies. Quite a signal there, and you can see that Alibaba, Baidu, and JD.com all higher right now, Matt.
All right, so some movement under the hood, and of course, as I said, M&A Monday. We've got a big deal today. It's really an A, right? It's always an A. It's never an M. That's just PR spin. But Interpublic is up after Omnicom agreed to buy it and create the largest advertising company in the world. Meanwhile, 2 new stocks are set to join the S&P 500 at the end of the month, so we've got some additions to the index. And for a closer look at those, Apollo and Workday, let's bring in Isabel Lee. So this can make a big difference to your stock. If you're included, obviously, in the S&P 500, a lot of other funds, ETFs, need to track that stock.
Yes, and inclusion really elevates a company's profile. Of course, you have to meet some share float standards and an 18 billion market cap, but you're automatically in the S&P 500, which, as Katie knows, all the big ETFs track. Like the top 5, out of the top 5 biggest ETFs, I think 3 track the S&P, or is it even 4? But
yeah.
Imagine you're automatically going to be having Apollo and Workday in your portfolio, which is a big thing. And Apollo has been really on, I think I've written a template for Apollo for like 5 quarters, because ever since 2022, investors have been eyeing that they will be joining the S&P ever since they merged with Athene.
So finally getting that blessing added to the S&P 500, but it's a zero-sum game. Who was booted out while Workday and Apollo were added?
Booted out were really Corvo and Amentum. And Apollo, I think, I'm going just back there because it joins Blackstone and KKR in joining the S&P. It's the holdout. KKR and Blackstone joined in the previous quarter. So finally, there are 3 in the club. We know that alternative asset managers are making a big, really splash in this market. Apollo, ever since it reported quarterly earnings that beat estimates, its stock has risen more than 20%. So it's really seeing a good year. And Workday also, I mean,
yeah,
everyone uses Workday, or most people use Workday. It's like a software that you have for when you look at your HR task, among others.
Yeah, very well acquainted with Workday. Isabel Lee, great reporting as always. That is Bloomberg's Isabel Lee. And we were talking about all the ETFs that track the S&P 500. No one tracks the Dow Jones Industrial Average. I'm exaggerating a little bit, but just barely.
Really, there's no Dow Jones ETF?
I'm going to go back and fact check myself, but the importance of the S&P 500, it's hard to overstate when you think of just the trillions.
It's not enough for you to stick the knife in, right?
No,
you just need to occasionally twist it
a little bit.
Yeah, I'm looking at ETF Go. So the top 5 by assets, if I've done this correctly.
It looks pretty good so far.
SPY obviously tracks the ETF. VU, that's Vanguard's version, right? And then IVV.
That's iShares, so that's BlackRock. So the top 3 biggest ETFs by assets.
But even Vanguard's total stock market ETF, I mean, it basically does, right? And then you get the Qs. So
then you get the Qs. So there you have it. Really interesting, of course, a huge coup there for Apollo and for Workday. But let's broaden out this conversation beyond the benchmarks. We'll do that with Nimrit Kang. She is Northstar Asset Management Chief Investment Officer. Great to have you with us on this Monday. So far today, we were talking about the big call from Oppenheimer. They see the S&P 500 ending next year at 7,100. But then we were talking to Cole Smead about how this is a fully allocated market and that the incremental buyer maybe just isn't there. When you think about the motion of markets into 2025, where do you fall on the debate?
The market's priced for perfection. I mean, we're looking at almost 30% increase in S&P 500 for this year. That's on the back of 25% the year before. So on a 2-year basis, looking at market up about 60%, that is priced for perfection. The market is telling us that everything's going to go right with, the tax cuts. Everybody's going to have more tax cuts. The corporate tax cuts are going to go down. Earnings are going to go up. We're going to have deregulation, M&A, just like the deal we saw today. So it's animal spirits. But I think it is important to remember, Katie, that there is a non-zero probability that things might not just go exactly the way it's laid out at this point. For example, tariffs, mass deportations, the cuts in the federal budgets, and what that does to the payrolls from the government. And even if you take a viewpoint that could be temporary, at least it raises the probability that we might have short-term hiccups. And, intra-year, every year, we usually see 14% on average declines in the market since 1980. So we would be cautious going into 2025 and just taking, leaving a little bit of dry powder aside to be able to take advantage of those opportunities.
Yeah, I mean, we were having an interesting conversation with Cole Smead about, just who is left to buy stocks anyway. I mean, even if you don't have any negative results from tariffs, mass deportations, even if we don't slash budget and government spending to the point where it doesn't grow the economy anymore, what money is left to buy these stocks if U.S. households, institutions, and international investors are all fully invested? Where does the cash come from?
Matt, we're back into Tina. There is no alternative to U.S. equities in some ways, right? And the reason I say that is look at what's happening with the bond market. You know, the bond market is flip-flopping all over the place. Just with the announcement of Scott Bessent to take over the Treasury Secretary job or as a nominee, the bond markets, the bond yields, you know, came down 20 basis points and resulted in loss if you were holding the bonds there. So there is no alternative. The bond markets with the secular pressure on the deficits, we don't know what's going to happen there. You know, investors don't want to just be holding on to bonds. Internationally, what's happening all over the world, you know, Korea, the geopolitical instability in different parts of Europe, other places, that just leaves us back to the US as the place where we want to own risk assets and equities. And yes, there's a lot of upward bias, positive bias, if you take a long-term perspective. You know, all the things that are on the table, deregulation, tax cuts, that's going to help. It's just not going to be a linear trend.
I'm so glad that you bring up the bond market. I want to talk about that a little bit more and where it fits in a holistic portfolio, because yes, yields are relatively high right now. You can look at the 10-year Treasury yield and say that looks pretty good relative to recent history, but just the volatility coming from the bond market, it's not exactly this portfolio ballast like it has been in the past. And I just wonder how you think about that, Nimrit.
Katie, our whole paradigm of portfolio management is really making us think a lot, right? So bonds, you know, we used to think about bonds as the safe asset. And 2020 showed us, well, nothing's safe, especially when the Fed starts to raise interest rates. So we saw first one of the bigger magnitudes of declines in the bond markets. Bonds do definitely have a role in the portfolio, but that's not your growth asset. And you have to keep in mind that if there's a secular pressure upward on the yields on interest rates, because of the world that we're living in, where we have these promises we've made on Social Security, Medicare, entitlements, at the same time we have to do a lot with infrastructure, where's that money going to come from? And we're cutting taxes. And sure, we can say, you know, we can go with the tariffs and deregulation, but the net of it is not obvious and clear to us. So absolutely, the bonds have a role in the portfolio, but you're not in a position where you can say that's going to get you home in terms of, you know, long-term returns.
Can you count on, is Santa Claus something you can count on, Nimrit, every year? Do we rally up into the end of the month because of window dressing? Is the January effect something that's pretty dependable?
Well, the Santa always shows up, Matt. So we're going to go with that. The momentum and the trend is pretty strong. We're not into the short-term timing, but, you know, the odds and the probabilities are so skewed that we're going to finish strong this year and then deal with some of the aftermath of that into early months of 2025, we think.
All right, Santa Claus is real. You heard it here first. Nimrit Kang of Northstar Asset Management. Always great to speak with you. Thank you for joining us. Now, coming up, two advertising giants join forces to create the largest ad company in the industry. We'll have the details on the deal next. This is Bloomberg. All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Advanced Micro Devices no longer a buy at Bank of America. The firm is downgrading the chipmaker to neutral, citing competitive risks. Analysts saying that there's an increasing preference for custom chips made by Marvell Technology and by Broadcom. Next up, we have Reddit getting upgraded to a buy at Morgan Stanley. The analyst is also tripling his price target, taking it from the lowest to the highest on the street. He admits he missed the boat on Reddit's IPO gains, but feels that there is still time to jump on board. Shares up almost 5%. And finally, Tesla's price target getting raised at Bank of America on confidence in its growth prospects. The higher target comes after the analyst visited the company's Gigafactory in Austin. Deutsche Bank also raising its price target on Tesla today to $370. Shares up about 2%. At one point, it hit the highest since, I think, November 2021, Matt.
All right, Tesla is doing very well. Not back to an all-time high quite yet, but definitely recovering from that massive slump we had at the at the end of 2021 and into 2022. Let's talk about M&A, because it is Monday and because we're looking at a new superlative. Two rivals have joined forces to create the world's largest advertising company. Omnicom Group agreed to buy Interpublic in this deal that was announced at 7:30 a.m. New York time. It's seen as a response to the rise of AI, which could replace some of the creative work done by agencies. For more on the deal, we're joined by Bloomberg's Leanna Baker. And I was looking through for a total deal value. Didn't quite pin it down, but I saw there's going to be synergies. And who doesn't love synergies, right?
It's an all-stock deal, so it's going to be worth about $13 billion, not including debt. With debt, it'll be worth even more. The companies did say there's $750 million in synergies, but it makes sense. These companies directly compete, and they will be able to cut down, I'm sure, on some costs, being
Firing
together.
people, basically. Mm-hmm. They're going to get rid of people's
That's
jobs.
the positive story around it. But you said they'll be the largest company as a media agency and in advertising. So Publicis and WPP are the companies that'll be most directly affected by this merger because they'll now have a bigger competitor to deal with.
I want to talk about what this says about the industry, because you had a Moffett-Nathanson note saying that basically this is an indication that the ad agencies need to cut costs and reduce capacity. Is there anything we can extrapolate out about the health of the broader industry from this deal?
As you know, the media landscape has been changing for a long time with legacy media, and these companies have evolved to use data and technology to do their media buying, but certainly they need to do more. The big tech giants are now, more of a threat to some of their business, so that's why you're seeing this. And there hasn't been consolidation in the space for a while, so this could lead to follow-on deals. Vivendi has announced that Havas would be spun off, for example. So we'll be looking to see what else could happen in the space now that we see this mega merger happen.
It's interesting to view this acquisition as a response to the rise of artificial intelligence. And I just wonder, in your role as head of the deals team here, how often have you seen that? Is it starting to be, a real driver for transactions?
We haven't seen it yet. We have seen that banks are changing maybe how they cover companies or investment banking clients with the rise of AI. But in terms of the media landscape, this is sort of one of the first, I would say, directly in response to AI. But that has to do with creative tools and how these agencies, make their material and commercials, something that's been really changing over time.
Let's talk about the antitrust component here a little bit more. Of course, this is a mega merger, mega acquisition, whatever you want to call it. It's big, theoretically. Do we see any hurdles here getting through this acquisition?
For sure. There's always antitrust risk when you have direct competitors coming together, but we are expecting a looser regulatory environment under the incoming administration. So that's definitely could have to do with the timing here. And maybe there are some markets, some micro areas where these companies compete. They might own PR firms in certain verticals, but these are massive conglomerates, so there could be something under the hood we're not thinking of. But in terms of how the landscape is changing, I'm sure the companies will argue that they're better together.
I just wanted to save a moment to talk about the Yankees. You are basically our resident Yankees fan, and they've lost, I guess, Juan Soto to the Mets for an astounding figure, 765.
It's funny, I don't know what player you're talking about, because as soon as I heard that news, that Juan
just
Soto,
wiped from your memory.
I have no idea what you're saying right now. So,
that is a very healthy breakup.
But I look forward to the Mets, never being in a World Series.
Leanna Baker, thanks so much for joining us. Leanna organized a Yankees trip.
Yeah, I missed that one, but I assume you had a lot of fun.
I hope we do it again, because it was awesome fun. Maybe the Mets this time.
Yeah.
Coming up, Blackstone running into resistance down south over a planned data center. We'll take a look at that fight in our Wall Street beat. This is Bloomberg.
All right, welcome back to Open Interest. Check on stocks right now. A little bit lower about 20 minutes into the trading session. The S&P 500, the Nasdaq 100 off by about 1/10 to 0.2%. The small caps remain dominant right now. The Russell 2000 up about 0.7%. We'll see if those gains hold, but the rotation trade in full effect right now. But it's time now for our Wall Street beat, and Blackstone is getting pushback from local residents in Fayetteville, Georgia, over a planned data center. The fight is the focus of today's Big Take, and Bloomberg's Josh Saul co-wrote the story. He joins us now in person. Josh, great reporting as usual. Just walk us through this fight and what it says about power and these AI centers.
Thanks. I mean, some people say we're in the fourth industrial revolution, and that means building a lot of stuff. In this case, it means building a big data center. Blackstone's QTS built this enormous data center. It's not quite as big as Central Park, but it's pretty close. People weren't that upset about the data center, but the power lines to bring the electricity to the data center really infuriated and angered this community.
One of the things that happened in the Industrial Revolution is a lot of people got killed. The workers mainly, and other people made a lot of money. It seems like that sort of balance is coming back here, right? The power goes to the AI data center also before it goes to the people that need it.
Yes, no deaths yet, but people really, really angry. What we're seeing here is that the amount of electricity needed is as much as 1 million homes. And that means that dirty power plants are kept on longer. And in this case, what really made people angry is that it meant power lines going through their property. Local officials felt like they didn't have knowledge of what was going to happen beforehand until Georgia Power, the local utility, workers were knocking on doors saying, we'd like to purchase an easement on your land, which basically means we'd like to pay you somewhere $10,000, $100,000 to build a huge transmission line through your yard.
So you focus on Fayetteville, Georgia in this Big Take, but I have to imagine that a similar fight is probably playing out in other parts of the U.S., potentially other parts of the world, because people up and down Wall Street will tell you that AI is the future, and this demand isn't seemingly going to go away.
100%. QTS, the Blackstone-owned company, they have a footprint of $50 billion in data centers, and their prospective pipeline is $50 billion more. This area in Georgia is not even one of the data center hotspots. It's not. It's not in Northern Virginia. It's not a data center alley. So yes, coming across the country. And the way I wanted to explain it is I wanted to use an analogy. Imagine your hometown, and imagine all of a sudden there's twice as many cars, or 10 times as many cars. That's what happens when a big data center comes, because it means that there's 10 times as much electricity being used. That many more cars means you need a lot more roads, and you need a lot more gas stations. Same thing when you build a big data center, you're going to need a lot more power lines, and you're going to need a lot more electricity, which means a lot more power plants.
Is there any benefit, though? You think about all those cars, they're carrying people who I assume have moved to the town, and there must be some sort of economic benefit there, right?
We all use data centers every day, everything we do. One example a data center developer used to me, I'd had a baby recently, and he was like, you know, every medical test that was run on your wife, that was run on the baby, that pinged on the doctor's phone, that all went through a data center, one of ours, one of the ones nearby in Virginia. That's one example that was very near to my heart, of course, but I mean, every TikTok video you watch, every national security test that's run, they all run through these. It's what we all use all the time.
Right, the TikTok point is important there.
The benefits are national.
Yeah.
Yeah, it's good to supply the Chinese with all of the secrets that we have.
You know?
The benefits are national, and the costs are only incurred by those in Fayetteville. That's the problem, right? Yeah. And I wonder if you can extrapolate that out. I mean, if the data center needs power, but the people of Fayetteville needs power, which one does the power provider cut short?
In 20 seconds.
So far, no power shortages.
No.
It's not as if homes are going dark because of this.
Not yet.
It's more that the data center itself needs a lot of power, and that's causing a lot of turmoil in places like this.
Josh, it's a great story. I recommend everyone check it out. You can see it on Bloomberg.com. You can see it also if you have a terminal. Just type NI Big Take. That's Bloomberg's Josh Saul. He helped write the story. Coming up in the next hour, we're going to count down to the CPI report with Sarah Wolfe of Morgan Stanley and talk about the IPO pipeline with Jeff Thomas over at the Nasdaq. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment. And coming up, stocks struggling to make headway with investors awaiting key inflation data later this week that should help shape the outlook for the Fed. And meanwhile, some momentum is building in the IPO market. We'll take a look at what's in the pipeline for the year ahead with Jeff Thomas. He is Nasdaq's Chief Revenue Officer and Global Head of Listings. And as Trump's tariff threat looms large, we'll navigate the road ahead with the CEO of logistics giant DHL Express US. All that and more coming up. But let's take a look at these markets 30 minutes into this Monday session. Volume is actually pretty high right now relative to the past 20 days. You wouldn't necessarily know it by looking at the market, though. The S&P 500 down about 0.1%, a tepid sort of movement there. The Nasdaq 100 a little bit more action to the downside, down about 0.2% on the big tech index, even though Tesla shares having a good day. And then you take a look at the bond market, a sell-off materializing right now. Yields about 3 basis points higher, but still at relatively low levels, relative at least to the past couple weeks or so. The 10-year Treasury yield still below 4.20, Matt.
Just creeping up there.
Yeah.
Creeping up a little bit. Hedge funds net bought U.S. stocks for the first time in 4 weeks. That according to Goldman Sachs prime brokerage data. Macro products such as indexed funds and ETFs made up nearly 90% of the net buying. Bloomberg's Natalia Knežević is here with more. Natalia?
Hi, Matt. Yes, speaking of those macro products, we saw lots of short covering across large cap ETFs, corporate bonds, as well as information and technology. Single stocks, they were bought as well, but at a slower pace. What really stands out is utilities. We saw huge buying across utility stocks. Then information and technology. This is interesting because it's important to look under the hood at subsectors. So, for example, software stocks were the most net bought, but hedge funds keep selling semiconductor stocks. Maybe it's a bearish stance. Maybe they are just being cautious into the year end. And then on the flip side, we see communication services, industrials, materials were the most net sold sectors. It's interesting to look at industrials because that move was largely driven by short selling activity, which reached the highest level in more than 2 years. One group of stocks that hedge funds liked last week was airlines, and that can be explained by really good earnings from some of the biggest airline companies.
Fundamentals there when it comes to the airlines, at least, in the latest update. But you mentioned caution heading into year end. Let's talk about that a little bit more. What exactly are you seeing in the options market?
Right. So if we look at the volatility index, the VIX, or volatility of volatility, which is VVIX, they are now down to the lowest level since July. But what's more interesting is volatility at the index level. So this chart shows the S&P 500 index volatility. It dropped, guys, to the lowest level we last saw in 2019, before the pandemic. That signals that traders are not willing to hedge, at least into the year end. And it comes despite the fact that we still have at least 2 big data points that can be a source of volatility, which is the Federal Reserve's meeting later in December, as well as CPI report this week.
All right, Natalia, thanks very much. Natalia Knežević there talking to us about positioning and a lack of hedging. Joining us now is Sarah Wolfe, Morgan Stanley Wealth Management Senior Economist. And Sarah, I wondered just what you think of this sort of sanguine lack of concern of VIX in the low teens and not a lot of hedging as shown by the indicators Natalia is looking at. Should we be more concerned?
Well, all of the data that's been coming in has been reinforcing that growth is strong, the consumer strong, the labor market data we got over the course of last week on balance was pretty rosy. The unemployment rate moved up a little bit, but openings were up, quits rate was up, and non-farm payrolls rebounded with upward revisions. And so people are pretty optimistic, but I think that there's a little bit of complacency to the risk that we could be seeing in 2025, in particular some of the negative growth policies and higher inflation policies around tariffs and immigration that could start to stir things up next year.
Yeah, and I mean, we look into next year. First of all, we go back to Friday. We got the NFP report at 8:30. You saw average hourly earnings a touch hotter when it came to the annual number. Then we were talking about the University of Michigan sentiment survey, and one-year inflation expectations were higher than the survey, 2.9%. We had been looking for 2.7%. So there's complacency, but there does seem to be some near-term concern that's creeping in here.
Well, I think that there's a lot of data coming in that's supporting that consumer spending could actually be stronger going into the end of the year and into next year before some of these negative growth policies hit. And we need to keep in mind that stronger consumer spending can cause a reacceleration in inflation. So labor income has reaccelerated into the fourth quarter. We're going to get some of the positives of a wealth effect from the equity rally over the past quarter. Loan growth is picking up again. So these are all positives for the consumer. And we saw it in the holiday shopping data. That could carry into the first quarter, but then you need to think of the flip side of the coin, right? If economic growth is going to be strong and perhaps reaccelerate, what could that mean for inflation? And what could that mean for Fed policy? It seems that markets are pricing in this reality where they've taken off a couple of cuts next year. We're probably going to see that next year reflected in the December summary of economic projections, where growth is still strong, but inflation's a bit higher. And as a result, the Fed's going to have to pull back their cut expectations and likely pull back the cadence of their cut. So it's very unlikely that we're going to be getting a January cut with this type of momentum.
And we do want to bring you some breaking news, Sarah. Hang tight for just a minute, because Mondelez is said to explore a takeover of U.S. chocolate maker Hershey. This, according to sources here. The Mondelez deal for Hershey would require Hershey trust backing, but according to sources, according to reporting, Mondelez deliberations are early stage, deal not certain. But let me just repeat that one more time. Mondelez said to explore takeover of Hershey. Hershey shares currently paused for volatility.
Yeah, but the biggest gain that we've seen in years for Hershey. Hershey has a market cap of about $35 billion. Mondelez is a much bigger company, about $84 billion. It's not the first time that Mondelez has looked for a deal with Hershey, has attempted to buy the company in 2016. It walked away from discussions about a potential acquisition after seeing a $23 billion bid rejected by the chocolate maker. And of course, it is now 50% bigger. So I think absolutely fascinating in the world of chocolate. Obviously, Hershey is a gigantic name in the world of foodstuffs. Mondelez is probably the worst named company. I mean, what's Mondelez mean? What is that, Mondelez? It sounds like spray cheese.
Yeah. Of course, Mondelez makes many products known for its chocolate. And you mentioned Hershey having such a brand name, of course, is iconic. But shares have been struggling as of late, down about 6% year to date when it comes to 2024 performance. So clearly a little bit of a struggle there. And now Mondelez is apparently seeing an opportunity. Again, according to reporting, we will bring you more details.
Yeah, according to people familiar, Crystal C headlining this story. It would be the biggest deal since Mars
with Kellanova,
bought
right?
Kellanova, which is also a company where you're like, how did they come up with that name? Like Kellanova, Mondelez?
These are all good questions.
MongoDB, Snowflake.
Hopefully,
somebody needs to work on these things.
Crystal will come on and she can talk through all of that.
Very big deal then. Another big chocolate deal. Sarah, you know, M&A seems to be, obviously it's Monday, so we're going to get a few of these announcements. And we had the world's biggest advertising company created or potentially created with Omnicom's suggested purchase of, Omnicom?
Interrepublic.
Interrepublic?
Yeah.
Interpublic.
It's been a long week.
$25 billion revenue advertising company. Does it make does it make a difference? Do you think we're going to see M&A pick up, Sarah, as we get into maybe an era of deregulation? Is that one of the big drivers for the market next year?
Yeah, I mean, there's a few factors that are going to support M&A into next year. Deregulation is the one that's getting a lot of attention, but we're also going through a period of lower interest rates. So that's going to start to have a little bit less pressure on debt service obligations for companies, and it creates a less uncertain economic outlook. One of the things that we've been highlighting is that even though growth is poised to slow in 2025, the consensus forecast is about 2%. This past year, we're closer to 3%. The recession risks are a lot lower. So that's all being taken into account as companies plan for next year, and it's definitely going to be supporting a much stronger M&A environment.
All right, Sarah, appreciate you rolling with us. That is Sarah Wolfe of Morgan Stanley Wealth Management. Coming up, we're going to discuss that potential deal a little bit more. Of course, Mondelez exploring a takeover of Hershey. More details on that coming up. We'll also talk about IPO activity with Jeff Thomas. He is Nasdaq Chief Revenue Officer and Global Head of Listings next. This is Bloomberg. Well, back to the news we just broke minutes ago, and that is that Mondelez is said to explore a takeover of U.S. chocolate maker Hershey in a deal that could create a food giant with a combined sales of almost $50 billion. Here with more on this Bloomberg scoop is Crystal Say. She, of course, helped break the news minutes ago. Crystal, not just a movement in shares. The shares were halted. A lot of volatility here. Talk us through why this would make sense for Mondelez and why it might make sense for Hershey.
So first of all, this is a dream deal for a lot of deal makers out there. Like if you ask them, like in the consumer space, what are the deals you think should happen or could happen? This is the one. What really makes sense is that cocoa prices. It's a company and it's an industry that depends heavily on commodity prices. Cocoa prices has been going up, and both companies have been suffering. And on the other side, you have other industry trends like the GLP-1 that make people consume less and less sugar. The more health-conscious customers probably mean a bigger company, a more scaled company would make sense in this environment. Again, but this deal actually has been attempted in 2016, so it's not the first time we've seen this.
Well, and I think that's, for me, one of the most interesting things is the valuation, right? Because they tried this in 2016. I read in your story, in the nut graph, I believe, it says they walked away because it would have been $23 billion, right? But Hershey was worth 34 at the end of last week. So are they going to end up paying double what they would have then?
Yeah, but then like if you look at the overall like prices in the past like 52 weeks, like it's actually come down. A lot of the trends that we have seen here is very different from 2016, and that's a pre-COVID world, that's a pre-Ozempic world, you know, all of that stuff. And then you also see a lot of potential hurdles in this situation as well. You could potentially see, you know, the Hershey Trust plays a huge role in whether this deal goes through. The trust owns almost all the Class B share, giving them like superior voting rights, and all of that like puts a very, very difficult hurdle on this deal. So this is a preliminary approach we should stress, and whether it happens, it still remains to be seen.
Great point, of course, on the trust. Some interesting politics to work through there, if you want to call it that. But talk to us a little bit, too, about the regulatory landscape and the anticipated regulatory landscape when it comes to 2025 with the Trump administration back in office here. With a deal like this, would we be expecting any antitrust concerns?
So overall, the M&A market is expecting a much more friendlier antitrust environment in 2025 once the Trump administration perhaps swap out the FTC chair. We haven't really. This is a deal that would, in a normal circumstance, attract antitrust reviews. So I don't think we're there yet. Like we said, it's a preliminary approach. Also, the other thing that is unique to the situation is that the deal is subject to approval of the Attorney General in Pennsylvania because of the trust structure. So there are a lot of regulatory hurdles on top of the market hurdles. So again, like a preliminary approach. So would love to see this deal happen, but they really have to jump through a lot of hoops.
Well, fantastic reporting, as always. Of course, Crystal and the Bloomberg Deals team working all weekend to bring you this scoop. Our thanks, of course, to Bloomberg's Crystal C. Now, let's keep this conversation going now with Jeff Thomas. He is Nasdaq's Chief Revenue Officer and Global Head of Listings. So clearly, deals are back in a big way when it comes to this market, Jeff. When does the IPO market heat up in a similar manner?
Yeah, well, I'm excited to say we've had over 160 IPOs on Nasdaq this year, helping companies raise over $20 billion, which is a 3-year high. So things have already been ticking up slightly, and we're expecting a fairly busy 2025. We're in touch with a lot of companies that are planning IPOs in Q1 and Q2, and so we expect the year to start off strong.
So what kind of strength is that you expect, Jeff? I mean, you have a great look at the IPO pipeline. Obviously, you're talking with companies before they file. What kind of 2025 could we expect?
Yeah, we've seen a lot of activity from private equity sponsors. So there was a large chunk of the proceeds raised this year came from sponsor-backed deals, including the largest deal of the year with Lineage Logistics on Nasdaq. So we are in touch with a number of private equity-backed deals that are looking at IPOs in 25. And the fact that we're seeing M&A come back to the market actually bolsters that case. I think a lot of sponsors want to see a dual track. And so when there's a healthier M&A market, it actually leads to more IPO activity. We've got a number of biotechs lining up for Q1 IPOs. JP Morgan's healthcare conference in January is always a big kickoff to the year, and we always see a number of biotechs get out after that. And then obviously we've got ServiceTitan pricing their IPO later this week. And so we hope that'll be a nice lift for venture-backed tech companies as well.
We'll all be at that JP Morgan healthcare conference, so looking forward to that and the news that may come from that setting. But I do want to talk specifically about small company IPOs. It's something we talk about on this show all the time, the fact that you have companies staying private for longer, as you know very well, and then when they finally come to market, in a lot of cases, or many cases, they actually skip the small cap indices altogether. And I'm curious whether that's a trend you see changing in 2025, or might it take a little bit longer?
Yeah, and with some of the appreciation, some of the small cap indices actually have some pretty large companies in them. So the Russell 2000 Growth Index, which a lot of fund managers benchmark against, has companies up to 10, maybe even $15 billion market cap. So there is some pressure there where you want to be of a decent enough size where some of these fund managers can seek to own you. As you know, there's a lot of capital in the private markets for a lot of these high growth names. And so that's one of the other reasons companies will wait longer to go public. And that was one of the reasons we established Nasdaq Private Market 10 years ago, to make sure that those companies had a way to provide liquidity to their shareholders in advance of an IPO. But I think as we see general risk on mindset come back into the public markets, we're going to see more and more companies looking to the IPO markets and looking to go earlier in their life cycle after a pretty cool environment for the past couple of years.
You know, we were talking about Mondelez and its bid for Hershey, potential bid for Hershey, being interesting in a number of ways. One of them is that Mondelez was listed on the New York Stock Exchange until it transferred over to Nasdaq. And you've had a ton of transfers from, you know, many different exchanges, not just the NYSE this year. I think more than 500. How much growth do you see in that? And does it continue into 2025?
Absolutely. So if you go back, it was about 20 years ago when the SEC changed the rules where a company could take their stock ticker from one exchange to the other. And so now once that was in place, it really opened up the competition for these existing listings. And since that time, we've had 500 transfers from the New York Stock Exchange to Nasdaq, including Mondelez as part of the Kraft Foods split back in 2012. And more recently, another great snacks company, Campbell's, when they did their rebrand, was the one that we announced with that 500th milestone. And then even more recently, Palantir Technologies. So we continue to see a lot of interest for New York listed companies coming to Nasdaq for several reasons. One, we support a lot of New York Stock Exchange listed companies through our investor relations solutions. So when they have a question about what's going on with their stock, they're calling the analysts at Nasdaq, not the New York Stock Exchange. A lot of them are very interested in getting into Nasdaq specific indexes, like the Nasdaq 100, which has been a really fast growing index and one of the best performers of the year. And then obviously, I think the affiliation with the Nasdaq brand, which stands for innovation and forward thinking, is the third big driver.
Well, Jeff, I'm glad you brought up Palantir. That was fascinating to see the company come out and say that basically they want to be included in the Nasdaq 100. We know that being included in a lot of these indices can mean big money when it comes to some of that passive bid there. I mean, when it comes to competing for listings and for switches, as you've seen here, how big of a draw is that? I mean, what is your competitive edge to offer these companies?
Yeah, so the Nasdaq 100, which represents the 100 largest non-financial companies on Nasdaq, ends up being nearly a 4% shareholder in the names that get into that index. And that's across both the Invesco QQQ ETF, as well as all the other tracking ETF and tracking funds. So it becomes a major passive shareholder. So it is a really big draw. In fact, nearly a quarter of the companies in the Nasdaq 100 have transferred from the New York Stock Exchange to Nasdaq to get into the index.
Jeff, great having you on the program. Hope we can get you back here in the studio soon. Jeff Thomas there coming to us from Nasdaq. Still ahead, Miller High Life is releasing a new scent that may have you reminiscing about your local dive bar. Does it pass the sniff test?
No.
Details next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Reddit is testing a new AI-powered chatbot as it looks to increase user interactions and keep people on its site. I didn't know it had a problem with that, but in any case, the chatbot, it's called Reddit Answers. It will help users find information, make recommendations, and also surface discussions across the platform. Next up, it's no fiesta for Chipotle lovers. The burrito chain announcing it will raise its menu prices about 2% nationally. Chipotle said in October that its food, beverage, and packaging costs all increased in the third quarter, and it cited avocados as a prime example. And finally, this holiday season, are you in the mood for a little ode to stale cigarette? Miller High Life is releasing a new cologne that's meant to smell like a dive bar for $60 a bottle. Geez Louise. The scent blends together cedarwood and patchouli to recreate the smell of a bar counter, tobacco and leather to evoke worn-in leather bar stools. Social media users are having a field day, with one commentator saying, "Does it smell like shattered dreams?" No. Matt, I don't know. Maybe on your Christmas list, it could be a stocking stuffer.
I am not convinced it's going to be that awful. When you say patchouli, I'm in. So I'll try it.
I don't know. I could think of a lot of better smells, but in any case, let's get a check on these markets. You take a look at the S&P 500 right now, still pretty quiet, but these losses becoming more defined, down about 0.2%. The Nasdaq 100 down about 0.3%, a little bit of a sell-off in the bond market. Now, coming up, we'll have a great conversation with the CEO of DHL Express US. Don't go anywhere. This is Bloomberg.
It's that time of year when we brush off concerns about tariffs, unfair labor practices, and global warming and order anything and everything we can get from Asia. But the holiday shopping season excitement was muted at brick and mortar stores here in the U.S. over Thanksgiving. So how will the balance look as we head into Christmas? Someone with an amazing view on all of this is Greg Hewitt. He runs the U.S. shipping business at DHL Express. And Greg, we're just interested to know if this season is going to be better than last in terms of shipping, and how much better, if so.
Good morning, Matt. Thanks for having me. So far, so good. I will say we anticipated peak season to be about a 40% lift on our normal daily run rate. And
that's massive. 40% better than last year?
40% better than our norm. And it actually came in 60% higher than our norm. So year over year, looking good, better than we anticipated, shows strong consumer demand, but we're going to have to see that carry through to the end of the year.
I'd love to talk a little bit more specifically about different regions. Are there some countries that are doing maybe better than others here, Greg?
Well, definitely imports in from China are still an important area, but we've seen strong volumes coming in from Europe. We've also seen strong volume going outbound to markets like Europe. And definitely we've seen the growth of what many would call the China plus markets like Vietnam, Malaysia, India, and Mexico.
I actually asked the CEO of Lamborghini last week if they were shipping more cars over here to get ahead of expected tariff increases. They're not. But I imagine other businesses are doing that, Greg. Do you see some business being pulled forward from 2025 on concern that there will be higher tariffs then?
So far, no. I wouldn't say that we've seen this huge rise, a big spike after the election that was an indication that people are preparing for tariffs. If you remember back, we were worried when the last set of Section 301 tariffs came in. Yes, there was growth in some new markets like the ones I mentioned, but overall, there was still strong trade with China. They have a strong manufacturing base, a good cost base, good quality. I expect that to continue as we head into the new year. It may mean some increases in prices, though, as companies try to pass that cost on to consumers.
We just had the second hottest November on record. This year is expected to be the first with a temperature that's more than 1.5 degrees centigrade higher than the pre-industrial era. I guess you're going to continue to face higher regulations, pay premiums for fuel that pollutes less, worry about lawsuits and reputational damage from global warming. How much is that eating into your margins?
Well, I think we had a very strong strategy around becoming carbon neutral by 2050, and that included a significant investment in sustainable aviation fuel. So that was planned into our results, and we've carried forward with that. Now, what we've recognized is with increasing costs and scarcity in those fuels, we're leaning on and working with our customer base through our new Go Green Plus product to help our customers inset their carbon emissions and join us in buying more sustainable aviation fuel.
I actually want to go back to tariffs, Greg, because I mean, every C-suite conversation we have, it feels like that is the big cloud that hangs over the conversation. And usually it's about what tariffs could mean in terms of hurting the business. But when it comes to DHL, those higher costs, could it actually be a tailwind for your business?
Well, I think first and foremost, it can represent an income stream, I guess, as we have to increase our customs clearance capabilities to be compliant with new regulations, new tariffs, new duties. Obviously, there are fees that we can pass along as part of that. We see that in many countries around the world. The U.S. has the highest de minimis right now. If that were to drop, it would mean that we need to work with Customs Border Protection to increase our staffing to clear those additional goods and assess fair duties and taxes, but we can also charge for that as well.
I'm also curious to hear your thoughts on what potential tariffs that have been proposed by President-elect Donald Trump could mean for supply chains. It feels like we haven't talked about supply chains very much recently, at least relative to some of the extreme weather events. But what impact could these proposed levies have on supply chains?
Well, I think it means you're going to need greater diversification. You're going to have to continue to look for opportunities to find places where you can achieve the quality and I guess the cost base that maybe you used to enjoy in a market like China, and move some of those productions into those countries. I think if we learn from the last time, though, China has a very strong and capable track record in terms of manufacturing and quality, and it's difficult to easily replace it all. So I think you'd see some of it shift to markets. A big one would be, say, Mexico, just south of us, where you could bring goods for your supply chain closer to your market, hopefully achieve the same cost and quality, and avoid maybe some of the duties off the table for potential tariffs.
All right, you froze up for a second, but we got you back, thankfully. I wonder about labor costs. I imagine they're your second biggest cost, certainly in the last mile. Labor must be expensive, and if the labor pool shrinks, you could be looking at higher costs there. How are you doing with those costs?
I think we're back into more of a period of normalization. Certainly coming out of the pandemic, we saw maybe a scarcity in employees. We saw some rises in terms of the wage rates that we needed to honor. We saw some heavy increases in our union contracts. I think it's more normalized now, and we plan for those cost of living, and we've got a strong and stable employee base.
All right, Greg, really great to get some time with you. That is Greg Hewitt. He is the CEO of DHL Express U.S. Meanwhile, let's go back to that Bloomberg News scoop that Mondelez is said to be mulling a takeover here of U.S. chocolate maker Hershey. Take a look at Hershey shares right now, absolutely flying right now, up about 15%. They were halted for volatility at one point. And we were just having this conversation with Crystal Say, and she made the very good point, that this is very early, it's preliminary, there's a lot of details to work out. So we'll see if this even happens, but really interesting potential combination.
Yeah, and it could be huge in terms of the price, right? Hershey, the market cap last week was $34 billion. As she said, it's come down over the last 52 weeks. So they may have to pay up. And of course, they're going to have to add some kind of premium. So you could imagine even a price that's double what they were looking at in 2016 at $23 billion. Crystal's great at breaking these scoops. And a great way to understand how her last name is pronounced is to think about clear water.
Yeah.
It's like a crystal sea.
Yeah, perhaps with some salt in that water. Yeah, I messed it up, and I'm kicking myself about that, especially because she is such an all-star reporter. Of course, our entire Bloomberg Deals team, it feels like, combining to break this news. And she made the point that there's a lot of sort of interesting politics with the Hershey Trust here. They own almost all of the Class B stock. That is roughly 80% of the voting power at the company. So obviously, this would need the backing of the trust as well.
Yeah, and you've got to wonder how the United States government's going to feel about the chocolate market. You know, they already got all out of sorts when it came to the kind of mid-tier handbag market. So they're paying attention, at least now, still, in terms of monopoly concerns.
Yeah.
And Mondelez is already a very big business. Of course, you got one big competitor in Mars and Kellanova, but this would be something that you would think that Lina Khan is going to take a look at.
Yeah, I am fascinated to hear how those conversations sound in 2025. We'll see, of course, if the incoming Trump administration is more amenable to a deal such as this one. But in any case, let's take a quick look at these broader markets right now. You can see actually taking a turn lower in the S&P 500. We finally have some action at the index level, and it's to the downside. The S&P 500 down about 0.4%, being led by big tech here. The Nasdaq 100 down about 0.7%. We'll continue to follow that one. This is Bloomberg. All right, it's time for our daily Wall Street Week conversation. And before the 2024 election, then presidential candidate Donald Trump said he would eliminate the Department of Education. David Weston spoke with former Secretary of Education Margaret Spellings about how abolishing the agency would impact federal spending and the future workforce.
My own view as a Republican is, look, if we're going to spend federal money, we ought to get something for it. If we say that our urgent imperative is the capacity for Americans to be successful in the workforce, reading and math and basic abilities, that's the main thing. And so these other issues are, really maybe do rightly belong in states and localities, and maybe we ought to have accountability to find out how they're doing with respect to those.
If you were going to advise Linda McMahon, who's been nominated to be Secretary of Education the way you were, if you were going to advise her coming into an administration where her boss, the president, has said he doesn't want a department at all, what would you advise her? How does she go about this?
Well, I think, find out what the biggest problems are. And as I said, most of the Department of Education is around higher education funding and supports. We've seen a fiasco around FAFSA, the ability or inability to get that financial aid form in the hands of people so that they can, chart their trajectory forward. So I think there's a heck of a lot of room for improvement. I think the first thing that has to happen is a clear-eyed diagnosis of where the biggest bang for the buck can be found. And I would commend the higher ed side of the House probably is the riper work.
How much money could be saved if you eliminated the Department of Education? As you say, is this a political thing or is this actually a money-saving thing?
Well, I guess both. I mean, tens of billions of dollars obviously could be saved if you eliminated every bit of it. Is that what we aim to do? Do we aim to eliminate any focus on special education students and the requirements in federal law that have really helped that population really become, have a seat at the table? Do we really aim not to support post-secondary education in any way, shape, or form? So, yes, you could save a lot of money, but again, I think what we're really talking about here is how best to organize and whether to devolve some of these programs with greater authority to governors and states, as opposed to eliminating the funding altogether. But that's a question for the Congress.
This is Bloomberg, and so one particular way into this question for a lot of people who watch this is, what does it do to our workforce? Are we going to have the trained workforce we need for the next generation?
That is the number one question, and as I talk to business leaders around the country here as part of the Bipartisan Policy Center, that you hear it from every CEO. Every single entity is worried about the quality of their workforce. That is what is going to drive their growth. And that's what it's going to drive our country's growth, too. And so, yeah, I think it is a national imperative. Can we have a lighter hand? Can we be more about a research agenda? Can we be more about, data and accountability as opposed to telling them what to do, telling them what we desire instead? Yeah, I think there's, we're constantly recalibrating the federal role.
And that was former Secretary of Education Margaret Spellings. And David Weston joins us now on set. I thought it was interesting what she had to say, that we need a clear-eyed diagnosis of where the biggest bang for the buck can be found. When it comes to how DOE money is currently spent, currently allocated, what does that look like?
Well, first of all, one of the things I learned from this is the vast majority of the money dispersed through the Department of Education is for higher ed. It's not for K through 12. It's only about 20% or 25% goes for K through 12. So it's not the public schools. And a lot of that is grants and loans for student education. And most people I talked to said there's a lot of waste there, that has not been done particularly well. So, but the basic question we had was, okay, if you do this, what does it mean for education? What does it do for kids? What does it mean for the budget?
Also, I mean, do we really need help in that area? I feel like the help Americans need is pre-K education, not post-12 education.
Well, that's absolutely right. But we're sort of late to the game on that. We've not done as much on pre-K. I mean, except locally, there's been some pre-K efforts made. And you're right. I mean, most of the research now suggests, I mean, you lose the kids before they even show up for kindergarten. But if you're trying to catch up by the time they get to kindergarten, you're already behind. It's awful hard to catch up.
So Margaret Spelling's just one of the conversations you had on this topic. When it comes to some of the other people that you interviewed, what was the spectrum of opinion?
Well, there was a range, because Margaret Spelling's, I took as saying, look, there are obviously some rooms for savings and things aren't done well, but there are also some functions there that are important. We had Mitch Daniels, who, as you know, ran OMB at the federal level and then was governor of Indiana and head of Purdue. He said, just abolish it. It's all a mess. It has no reason to exist. It's been a waste, and just forget about it. But on the other hand, I went out to Long Island to Baldwin and interviewed the school superintendent out there, Sherry Cammey, and she said, no, it really plays an important role in her K through 12, particularly with respect to underprivileged children and also some of the kids with handicaps, those kids in wheelchairs. She said, if we don't have that money, it's going to be a real problem.
So when we get to Friday and we see at 6 p.m. Wall Street Week, is the focus going to be on the Department of Education or the other sort of changes the federal government may make to save money? What are we looking at?
Well, we're taking it one step at a time. And the basic question on this was, how much of the programs do you keep as opposed to the infrastructure of the Department of Education? And that's where Margaret started out was, if you want to really save money, you have to eliminate all the programs. And I'm not sure we want to eliminate all the programs, but it's what they're going to have to sort out with the new administration. But we're going to continue looking at other proposals from the Trump administration. Okay, if you really did that, how much money would you save? And, you know, what would it do to the people who are receiving the benefits?
Is the idea, I mean, I imagine you can use Project 2025 as a blueprint, right? Is the idea that the states should take over that spending?
Yeah, states or private sector. I mean, one of the possibilities here, particularly when a lot of the money goes on those student loans that the federal government loses billions of dollars on, the question is, shouldn't the private sector do that? The private sector did originally under George W. Bush, when Margaret Spellings was there. It was actually the private sector who did it, and then the Obama administration took it over, saying we're going to save money. And at least Mitch Daniels says, boy, the exact opposite happened. Actually, we lost a lot of money.
All right, David Weston, a lot of big questions. Really looking forward to the full episode there. That, of course, is David Weston, and you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, the future is uncertain for Goldman's Create Your Own ETF service. I actually broke this news on Friday that the ETF Accelerator program, you can think of it like a white label. It launched just over 1 year ago. Goldman has helped its clients launch 10 ETFs since it debuted with that first couple of launches. But now the bank reportedly is exploring strategic alternatives that could include a sale. Joining us now with his take is Eric Balchunas. He is Bloomberg Intelligence ETF analyst. He's also my co-host of Bloomberg's ETF IQ. I am so interested in your take because when Goldman started up this hub, this platform, if you want to call it that, it made a lot of sense, but just 10 ETFs have launched through it.
Yeah, it's interesting. This is they don't want to call it a white label, but for the sake of the conversation, we'll call it a white label. If you have an idea, your client at Goldman's, they'll launch your ETF. There are several independent white labels. Collectively, they have, I don't know, 75, 80 billion of assets and about 150 ETFs. So it's a popular way to get an ETF out if you don't want to do all the legwork.
Yeah.
So Goldman launched GMO, Rubini's ETF, high profile.
Yeah.
And I was like, okay, they're going to be like the C-suite white label issuer. I thought that was a good niche for them, but I don't know. It's a little bit of a mystery. Maybe because Brian Lake joined the asset management arm, they're actually going to go back to marketing their ETFs and double down there.
And that of course, is your speculation.
That's my
because GSAM, the ETF accelerator program, is part of Goldman proper, whereas GSAM, Brian Lake, is now a partner at that program.
I mean, I think it's fascinating, especially the idea that they've only done 10, and I think half of those were for one issuer,
they
right?
had several repeat customers.
So I feel like they could be doing more, especially in a climate when so many people are launching ETFs. Or is that no longer the case since I left the show ETF IQ?
Bring him up
so
to
much
speed.
has happened
Since I was violently replaced in my role as co-anchor of that program. Are you still seeing a lot of new launches?
Yeah, I mean, they're going to be close to 700 this year, and the old record was 500. But within those 700, there's been some Hollywood, right? You've got Tom Lee, Rubini, I would GMO, right? That's
Rubini did one with Goldman, right?
Yeah. And so
Bridgewater too, filing.
Bridgewater with the filing, Apollo,
potential pipelines.
So this is the perfect time to be that sort of like creme de la creme white label. Again, a little bit of a mystery. Again, my thesis is one of the big things they just did was hire Brian Lake. Goldman has been not that aggressive with their ETFs for the past 5 years. They were early, then they just kind of... Their own ETFs. So possibly this is part of a bigger plan, or, you know, Goldman also makes so much money. This is a tiny, tiny, tiny little slice, and maybe it's just not worth the effort. Big banks can afford to be like, nah, it's no big deal. If this were a standalone, though, this would be a nice upstart business, but for them, it's so small, so maybe it just wasn't worth it in their strategic view.
You know, you can still tune in to ETF IQ and keep up to speed with what's happening. It's every
Today
Monday
I will
at
stand
12.
by set and just take over after
If you could clap, too, that
you
would
leave.
be great.
Why don't the Flacks like the term white label? What's the problem with that term? Is it not a white label business, or?
There's some differences.
Well, like the white labels, they get, they're pretty liberal in what they'll launch, and sometimes they can be a little wacky. I think Goldman wanted to sort of like brand it as like somehow more serious or something. That was my take on it.
They're also not necessarily involved in the branding. Like, you're not going to see Goldman's name in the actual name of the fund. Eric, really quickly, and we'll be talking about this in about an hour, but in less than a minute here, who do you think could possibly buy the ETF accelerator? I mean, if they do proceed with the sale, they're still exploring alternatives here, but who could be in the buyer's seat?
Honestly, Title, ETF Architect, or exchange-traded Concepts. Those are the three fast-growing white label issuers, and maybe they add this on as maybe sort of a wing of their business that caters to the more high-profile kind of active managers. That might make sense.
Yeah.
But maybe JP Morgan.
Yeah.
Why doesn't ETF IQ pick it up?
That's true.
And then you could do your show, but also have a non-white label
Conflict of interest.
ETF IQ ETF. I don't know. Something to think about. We'll noodle on this.
Conflict of interest is what kept me from buying Bitcoin at $75 a pop.
Oh,
And
man.
here you go,
So
buddy.
you were early. I'll admit that.
He was early, and now he's
If I had bought
super
Bitcoin
late.
when you started talking about it, I wouldn't be here.
Well, good thing we're all here, but we have to say goodbye to you right now.
All right.
That is Eric Balchunas. You can tune in to ETF IQ today and every Monday at 12 p.m. Eastern, and you can read about the ETF industry in my weekly newsletter. We're promoting it. That's great. Bloomberg.com/newsletters. You can find it there. Matt, do you have anything to promo?
We should. No, I love your newsletter.
Yeah.
And ever since
Now
I
that you
found
know
out you've been putting it out last week, I've been reading it.
Wow.
So definitely a program that you want to watch. I think it's a fantastic show. ETF IQ at noon. Coming out tomorrow on Open Interest, Sarah Malik joins us from Nuveen, Cameron Dawson from New Edge, and Barry Knapp at Ironsides.